The markets seemed to react negatively to the Fed when Chairman Powell said,
"We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time."
But did the markets drop because of the Fed comments? Or did Chairman Powell's comments just add fuel to the fire? Well, you'll notice this week my background is quite a bit different. Unfortunately, my sister passed away this past week. So I'm out here in the Midwest and shooting this in my nephew and his wife's living room. So yeah, things are a little bit different this week. But let's get into it. The stock market dropping because of the Fed comments about potentially raising rates doesn't make any sense at all, given the dot plot Chairman Powell shared in his presentation. As Chairman Powell describes, the dot plot shows what the Federal Open Market Committee thinks interest rates will do over the coming years. Yes, Chairman Powell talked a hawkish game of raising rates as needed, but in reality, inflation is likely to moderate, and the Fed knows it based on their predictions of where target rates should be next year and after. And by the way, the markets know it as well, and I'll show you that in the first chart that I'm going to show you. But before we do that, just have a listen to what he said.
In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025.
By the way, if the dot plot predictions by the Fed play out moving ahead, the long Treasury bonds will move substantially higher in price from where they are right now. Remember, to be an investor, you have to take a longer view and seize opportunities when they present themselves. So if we take a look at interest rates on this chart, we're looking at two things here. What are we looking at? Well, the blue line is the price of TLT, which is an ETF that holds an average duration of 20 years, so long bonds. The orange line are T-bill rates. Now, the market controls the price of TLT, and the Fed controls the interest rate at the short end for T-bills. And you can see what that's done over time. So back here, interest rates were at 2%. We're looking at this axis for the orange line. They were above 2%, roughly 2.33%. Then when COVID hit, the Fed dropped rates to 0. And then they dropped them again when they should have been raising them here. And then they started this relentless, insane increase in interest rates here. Now, I'm going to point out a couple of things in this chart to you. So the blue line's telling you what the bond market thinks, and the orange line is telling you what the Federal Reserve is doing. And if we look back here, yes, interest rates went to 0, and you can see that the price of TLT really shot up here a lot. And then the price of TLT started to come down, even though interest rates were declining slightly. And then the Fed surprised the markets because why was TLT dropping here? Well, because the markets were thinking, okay, Fed, time to start raising rates. Things are getting better. You don't need to keep them at 0. What did the Fed do instead? You can see right here. It's a little hard to see, but you can see they dropped rates. So what happened right after they dropped rates again? Well, the price of TLT started to go up. And then as the Fed started to raise rates here, you can see that the price of TLT dropped. Now, I'm going to point out something kind of interesting here. So look at where it bottomed here. And the interest rate on T-bills was roughly about 4%. Okay, so you can see where the price of TLT was here. But look at what happened. So the Fed started to increase rates. And what did TLT do? The price actually went up because the market didn't agree that the Fed should keep raising rates. Now the Fed kept raising rates and raising rates and raising rates. And yes, finally, TLT relented and started to fall. But look where we are now. The current 90-day T-bill rate is at 5-point-something% here, call it 5.3, 5.4%. But the price of TLT is back here when interest rates were at about 4%. So the bond market, the long bond market, is not buying it. They're saying here, they're indicating that they think the Fed is done and interest rates are going to start to either flatten out or pull back. And why do I say that? Well, because TLT, if the rates are this high versus here, then the price of TLT should be lower if the market agrees with it. And the price isn't lower. It's the same as it was back here. So I think this is presenting a long-term opportunity for bond investors to make a lot of money when interest rates actually start to back off again. And I'm going to give you some advice. Don't pay any attention to what the mainstream media reports of why the markets moved one way or another. It's really treacherous to link events to the movement of the stock markets, and I don't recommend trying to come up with a correlation. The news media outlets feel the need to make themselves more important than they really are by making statements like the markets went up today because you fill in the blank, right? Retail sales and unemployment came in better than expected, or the stock market dropped today. Why? Because retail sales and unemployment came in better than expected. You get my point? I've heard both of those scenarios over the several decades I've been a student of the markets and investing. There's a reason for the saying, believe half of what you see and none of what you hear. With that, let's take a look at the metrics and see what the metrics are telling us right now.
I'm afraid to say how I feel.
So if we take a look at the equity markets over the past week, you can see really not good looking, unhealthy, finished the week down. ARK Invest finished last, small cap second, NASDAQ and S&P kind of tied for third, and the Dow finished the best, even though it was down. So this is a very unhealthy looking market. And if we look back over the last month, not a good look, right? We're finishing the month lower with ARK Invest and small caps finishing dead last. And sort of a race to the top here for the Dow, the NASDAQ 100 and the S&P, although the Dow's winning, which is not healthy. And if we look at year to date, where are we? Well, we still have a fairly healthy rally going on here, but you can see that these indices, which were up 40% plus last week, are now only up 27% and 35%. So they're really starting to pull back
I
here.
wanna let you down.
And how does all of this show up in the bottom dynamics? Well, if we look at the current bottom dynamics, this has been really unconvincing. We had an unconvincing bottom forming indicator way back here. You can see it was at 100% and 100% up here, and it never really pulled back much. But what made it unconvincing? Well, you've got a dropping confidence level here. In fact, not just dropping, but it was below 80, dropped below 60, tried to come back, and then really plummeted here. So this is telling me, yeah, okay, stocks were bottoming here, but there was no conviction. There was no herd mentality racing for the door. Now, what happened after that? Well, we had a fairly convincing bottom confirmation. This blue line went to 100%, and you can see as it was rising up toward 100%, the confidence level was shooting up with it, and it was up here at 96, 97% when this was at 100%. That's a very convincing rally and a very convincing move upward. So where are we now? Well, as you know, stocks have kind of wobbled here and now pulled back. And you can see that the bottom forming indicator is coming up again, and it's near a place where you might say, well, we've got another bottom forming here. But look at what the confidence level is doing. It's rolling off again. So either A, we're not at the bottom and we're going to in for a lot more pain, and this is going to go up here to 100%, and this is going to turn around and go up into the high 90s, or we're going to get another situation like this where, it just kind of fizzles out and then the market starts higher. I don't know how to call that. There is no way to call it, but we're just going to have to wait and see how this plays out. And what if we look at risk versus opportunity? Well, I've been looking at the old metrics versus the new metrics, and boy, this is telling a story. I'm starting to realize that you can't trust this opportunity level over the short term because it really is a lagging indicator. It really is slow to respond. But you can trust risk acceleration, this yellow line, and you can see that has been moving higher, really shot higher again. Now on Friday, it's actually pulling back a little bit, which is surprising, but Friday was not a down day. It was Thursday was the big down day. So that's this upward move here. But the risk level, the red line, which is slower than the acceleration, is also shooting higher. So we took risk off of our clients' accounts last week, partly because of this and partly because of the other things I'm going to show you. So let's look at the new metrics. Now, these we're still trying to figure out how to read, but I don't think you need to figure out much here. Risk acceleration, almost at 90%, it's at 85%. That's insane. And you can see the risk, this red line, is shooting higher as well. So this is really not good. Now back here, you can see risk acceleration got up to here and then started to fall. But the opportunity level, which is kind of a lagging indicator, was declining. This would have been a good time in here to get out of the way. And you can see that the markets did decline after that. So we're still learning how to read these, but that's the story right now.
Don't wanna let you down.
And what if we look at equity versus safety? Now, again, we're looking at the old metric versus the new metric. Well, let's take a look at how the NASDAQ 100 moved as a function of time here. So 7 weeks ago or so, it was down here. It moved up to here, kind of went sideways. Then we got a really strong encouragement here, right to first place, stayed in first place. And then the week before this past week, it dropped. And then it really dropped this past week. So that's not good. Let's take a look at the cash. You always got to follow the money. So if we look at cash levels, you can see things were not good back here. Cash was in first place. Then cash fell to here. Then it moved up here, which was, I said in my video back then on September 8th, that scares me. And then it went up here to first place and stayed in first place. This is a very unhealthy looking equity market right now. And what if we look at equity versus safety using the new metrics? Well, there's some differences here, but you can see that, well, let's stay on cash. We'll do it in reverse this time. Cash was up here in first place, very scary. It just tilted down to second place, which was in the right direction. Then it tilted to third place last week. And now this week, it's back up in first place. What about the NASDAQ 100? Well, let's take a look at that. So NASDAQ 100, just like with the old metrics way down here, moved up a bit. Then it really shot up, actually, where the new metrics still had it fairly far, down this list. And then it moved up into first place, so that was encouraging, even though cash was up here. Stayed in first place while cash moved lower. I was hoping this would continue, but it didn't. And where are we now? Now it's down here at the bottom. Again, a very unhealthy looking equity market. And how does all of this show up in the buying and selling pressure? Well, no surprise here. I'm not going to spend a lot of time on these graphs, but you can see as the market is pulled back, the selling pressure, this orange line, has just gone through the roof. Now, the buying pressure is heading for it's extreme. It can't get below zero. So it's getting pretty close to that on the Dow. S&P 500, same thing, same picture. NASDAQ 100, a little more encouraging. You can see that instead of shooting straight up, it kind of started to moderate here on Friday. And so did the buying pressure. You can see that it kind of dropped here and then started going sideways instead of falling. Now, what about small caps? Well, small caps look somewhat similar and somewhat different. So you can see small caps peaked out back here, really have been falling. And you can see that the selling pressure has just been going up over this entire time since this peaked out back here. But again, the buying pressure is saturated here. It's at zero. It was saturated zero, and that doesn't quite work. But it's at the rails. It's as far as it can go. There's nowhere to go but zero. So it's as low as it can get. Okay, and what about sector rankings? Because these give an interesting picture as well. Now, the sector rankings move more slowly, so they kind of tell you where the market's been more than kind of where it's moving toward. But if we look at the old metrics, my God, last week, it was looking great, right? Consumer discretionary, technology, Bitcoin all up at the top here, cash, consumer staples, treasuries all at the bottom. Nothing could be better. Now we fast forward to this week, and I'm surprised Bitcoin and technology are still up here. Consumer discretionary has moved down, but you can see what's happening. Treasuries, consumer staples, and cash are all moving higher here. So that's not looking good. Let's look at the new metrics and see how they look. So if we look at the new metrics for sector rankings, again, somewhat of a similar picture. Consumer discretionary up here last week, but you can see that this was giving you a more true picture. NASDAQ was here, not bad, but it was behind the Dow and SPY. So this is saying that the risk appetite is becoming unhealthy. And you can see cash and treasuries and consumer staples were a little bit higher up here than they were with the old metric. Now, let's fast forward to this week. And boy, what a change in the picture. We've got cash all the way up here. Consumer discretionary has moved down here. Treasuries and consumer staples are moving up. But we surprisingly still have NASDAQ 100, SPY, and the Dow like this, which is, again, an unhealthy risk appetite. Now let's take a look at sector rank acceleration. Because these kind of are more forward-looking and kind of tell you where things are going. Now, last week, consumer discretionary up here at the top, but you can see that NASDAQ was down here, and cash and treasuries and consumer staples were all moving up toward the top of the table. That's not good. That was a signal there. Then we get to this week. You can see that Bitcoin's at the top, but cash and treasuries and consumer staples actually moved down a little bit, but cash and treasuries are all up here at the top of this thing, and consumer discretionary is all the way down here at the bottom. This is really not looking good. Now let's take a look at the new metrics. So new metrics, last week, a week ago, this was saying kind of there's danger here. Cash, treasuries, consumer staples ahead of consumer discretionary. You can see this is not a good looking market. And look at the NASDAQ all the way down here near the bottom. So not a good looking market. Now, what's interesting is the Dow's all the way up here, SPY's back here, and the NASDAQ is down here. This is a more accurate picture in my mind of what the risk appetite was a week ago when I ran that table. Let's move to this week. This week, cash and treasuries, consumer staples stayed put, but cash and treasuries are all the way up here at the top. You still have the Dow here, but now consumer discretionary is way down here. So not a good look. What's surprising is the NASDAQ 100 actually moved up from here to here. So not sure what that's about, but we'll keep an eye on it. But this really looks unhealthy.
Feel like I'm afraid.
And how have treasuries been doing? Well, not great. If we look back over the past 5 days, you can see that they all finished lower for the week, with the longest duration ones, EDV at the bottom, 20-year treasuries, TLT next, and then the shorter ones up here. So this is a very unhealthy look. How about over the last month? I don't think it's going to get any better. So yeah, not a healthy look over the last month. What about year to date? Well, year to date, you can see we are below this bottom. We're down here now. And if we look over 5 years, let's take a longer view. We're at or below this previous bottom in October. So this may be a really good buying opportunity for longer treasuries. And then what if we look at the maximum time frame? If we look at the maximum time frame, you can see that we're way down here. This looks like it's below all of these previous dips. So this may end up being the buying opportunity of a decade, but there's really no way to tell. Look, this is a good time, dollar cost average in, and I think over the long haul, when interest rates start to moderate and pull back, you'll be very happy that you're holding long treasuries. And how does all of that show up in the buying and selling pressure? Well, if we take a look at the buying and selling pressure for treasuries, you can see what's happening here at the long end. I usually start at the short end. Let's start at the long end. At the long end, you can see that the selling pressure well above the buying pressure in all situations here. So, and you can see the price has been declining. Now, if we look at the short duration treasuries, these are fairly short. You can see while the selling pressure has been above the buying pressure is starting to go up here. So right now, investors are moving more to the short end, which is causing the prices at the long end to fall. You can see they went up here. Now they went up everywhere on Friday, all the way across here. Probably investors are recognizing this is a heck of a buying opportunity. And what about that inverted yield curve? Well, if we take a look at this, the current one, this blue line, you can see it's becoming a little less inverted because long interest rates went up, which is why those prices are so low that I just showed you. A month ago, they were lower. And then if we look a year ago, the yield curve was just starting to invert and becoming worse. And what are the markets saying about what the Fed might do at their next meeting on November 1st, just about a month from now? Well, markets are saying they're going to keep rates flat. 72.5% feel the Fed's going to keep rates right where they are. And then there's a 27.5% chance that the Fed will raise rates 0.25%. And you know what I think based on the discussion at the beginning of this video and what we saw in the dot plots. And if we look back over time, and you can see here, last week, this was, I think, 73 basis points inverted, or 0.73%. Now it's a little bit better, not much, but a little bit, 67.8 basis points, or 0.678% inverted. And you can see how that curve has gone. We had a attempt here, really plummeted, and now it's been really trying to come back here. So hopefully this trend will continue, and the yield curve will eventually not be inverted, but I think that's going to take a while. And what about gold? Well, if we take a look at gold, it's kind of nowhere here. It's kind of up a little bit. We've got a little bit of a rally. The buying pressure was above the selling pressure, but now it's starting to drop. The selling pressure is starting to come up. I don't know where this is going. It's been kind of not a leader. Let's call it that. Not a leader. And what about Bitcoin? Well, if we take a look at Bitcoin, it had a very nice rally here. Now it's been dropping off as of late, and you can see that in the selling pressure, which is now above the buying pressure, and the buying pressure is collapsing here. So I don't know what that means going forward. It doesn't say good things, but we'll just have to wait and see what happens. Last week I said we're starting to see signs that things could become unhealthy. Well, this past week the markets showed us the downward direction for now, and we'll have to wait for signs that the appetite for risk is beginning to improve and not degrade as we just saw in the metrics from this past week. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
So you